पवित्रवतु ॐ चोदयेत्रे सूनृतानां चेतन्ति सुमतीनां यज्ञं दधे सरस्वती।
Good morning, friends. After knowing the basic books of accounts which we are required to maintain, such as journal, ledger, cash book, trial balance and other books of accounts, we have to first understand that why do we maintain these books of accounts, and for that matter our topic for the discussion is concepts, conventions and the accounting principles. Now let us first understand basically what do we mean by the term concepts. Concepts are the one which are necessary for any set of business, whether it is a sole trader, whether it is a partnership firm, whether it is a joint stock company, limited company, listed company, whatsoever it may be, but the concepts are basic thing. Now the sum of the concepts are their original. For example, we are talking about the retained earnings. What do we mean by the term retained earnings? Retained earning means the profit which is maintained in the books of account after doing all the adjustments. Let me repeat, the profit which is maintained in the books of account after doing all the adjustment. So that is the original concept of the accounts, that is known as the retained earning. But for the concepts purpose, we are not only dependent upon the accounting ideas or the concepts, but we are also borrowing some terminologies from the other subjects such as economics. There is one terminology which we are well aware about that, and that is known as a opportunity cost. Now what do you mean by the term opportunity cost? If you want to enjoy the benefit of one thing, then you are deprived, you cannot enjoy the another thing, and that is known as opportunity cost. So these are the two main things which are there. Now where do we use these concepts? We are using these concepts in all the areas, like financial accounts we use, the management account we use, the auditing we use, and even in the taxation we use. So all the areas which are related or ancillary to the accounts, we are using the concepts, conventions and the accounting principles. Now let us quickly go through what are the different concepts. If you can look at it, just see business entity, going concern, money measurement, accounting period, historical cost, matching of the cost and revenue, and the accrual. Now let us understand what are these concepts means and how do they impact our books of accounts or the maintaining of the books of account. Business entity. Normally we are confused that the owner and the business is one and the same, especially in case of a sole trader. We consider that Mr. X is doing some business. So we consider Mr. X and his business as the same, but the concept says no, Mr. X is a different and his business is a different. Only thing is that in case of the joint stock companies, we are well aware about that if there is a company known as a Tata, then we know one thing, Cyrus Mistry is the managing director or the head of the company, but Cyrus Mistry is different and the Tatas are different. But the same confusion may occur in case of the sole trader, but this concept says that the business entity and the owner are the two different. They are not considered to be one and the same. Going concern. What exactly we mean by the term going concern? Going concern means the business will have the useful life which is not defined anywhere. Let me repeat, business will have such a life, useful life, which will not be defined anywhere. So when you start the activity, it is known as a perpetual activity. For the companies, you must be knowing one thing. For sole trader, if the person expires, his business comes to an end. For partnership firm, if the person expires, the partnership will have to reform again the new partnership. But in case of the companies, it's having a perpetual entity. Perpetual entity means come what may happen, the company will keep on running the business, and that is known as a going concern. So going concern means having a perpetual entity of the business. The third one is money measurement. What is the meaning of the term money measurement? The meaning of the term money measurement means we are recording the transactions which has got a money value. So the transactions which cannot be expressed in terms of money has got no scope. Now I'll give one example. There are so many things which our parents are doing for ourselves. Now let us take an example of your own mother who is making you to wake up in the morning. She is giving you a good sumptuous breakfast and she is telling you, okay, now my dear child, you can go and attend the lectures. Now can you quantify or can you measure the value of the work which is done by your parent or especially by your mother? It cannot. So you cannot say that the services of your mother is worth rupees so and so. So the money measurement says that the transactions which are recorded in the books of accounts, they should have necessary the current as well as the future value. And those transactions are recorded in the books of account. That is the money measurement. Accounting period. Accounting period means what? It is exactly a period or the time limit. Imagine the situation that there is no time limit. I am just maintaining my books of accounts. Whether I will know by end of the year or after some time that whatever is my profit or loss, or whether my business is doing successfully or not, whether my sales are according to my expectations, are they comparable with my competitors, and also for that matter accounting period is required. And usually the accounting period is a period of 12 months. That doesn't mean one cannot have a shorter accounting period. You can always have a shorter accounting period, there is no problem. But usually the accounting period is of the 12 months. And in that 12 months, we maintain the different set of books and we arrive at the trial balance and last but not the least, the balance sheet. So there is a cutoff that is known as accounting period. So after that cutoff, we are going in the next year or the next accounting period. Now you know all very well, for the companies which are listed, they have to publish their performance, say quarterly performance, half yearly performance, 9 monthly performance and annual performance. So for them it is mandatory. So we can consider that quarterly performance will become the accounting period. A part of that first quarter, January to March, then April to, like that it will be continuing, and that is known as a accounting period. The another concept which we are going to study, that is known as a historical cost. Now what is historical cost means? Historical cost means the transactions are recorded in the books of account at the cost price and it has got nothing to do with the market value. I'll give one example. Let's say that I am having one car which is purchased by my great grandfather in the British period or some 50 odd years back for the value of rupees 10,000. My great grandfather has purchased the car for 10,000 rupees. Over the period of time I am using the car, my father was using the car, then it has got transferred in my name, I am using the car. If somebody wants to find out, because by the time that car has become an antique, and you know all very well what is the valuation of the antique assets. So 10,000 the cost price which I have purchased, or rather my great grandfather has purchased, today you will find the same value of the car must be running into few lakhs of rupees. But am I going to record that few lakhs of rupees in the books of account? Answer is no. So I will be recording the historical cost. Historical cost means the cost which I have incurred. So what is the cost which I have incurred? Of course that time it was 10,000 rupees. Since it is an asset, we are required to provide a depreciation on the asset. So I will be recording in my books of accounts the written down value or the value after subtracting a suitable amount of the depreciation. So that is about the historical cost. Then the next concept is coming, matching of cost with the revenue. What do we exactly mean? Why do we require to do the matching of the revenue with the cost? Please remember, revenue here means the income and the cost means all the expenses which you incur. See, it is a common thing that unless and until I do the comparison of my cost with the expenses or rather cost with the income, I will not be in a position to know whether I am in the surplus or am I in a deficit. Surplus means the profit, deficit means the loss. Surplus means the profit, deficit means loss. So am I doing my business activity in the profit or am I doing my business activity in the loss? And that is the reason why I have to match. Match means doing the comparison. And if I don't do the comparison, I will not be in a position to know whether my business is running into the profits and losses. See, initially when any business is started, it never goes into the profit. It takes its own time because we call it as a teething period. So there is a teething period which is necessarily required for every business. There is a teething period which is necessarily required for every business. But that day of teething period will be a limited one. So when you will start the business, initially it may be in the losses, but over the period of time you will cut down your losses. You will cut down your losses and you will say that right now I am selling the product at no profit, no loss. So when I am selling the product at no profit, no loss, I am working at break-even point. Break-even point means where there is a possibility that I am neither in the profit nor in the losses. So unless and until I do the matching of the cost and revenue, I will not be in a position to understand whether my business is running in the profit or whether it is running in the losses. The next one is the accrual, which is most important, which is very, very important concept for the simple reason. See, there are two methods in which the accounts are maintained. There are two methods in which the accounts are maintained. Number one, mercantile basis, and number two is the cash basis. Now, what is mercantile basis and what is cash basis? See, cash basis is you are recording the transaction only when there is the incoming or the outgoing of the cash. Cash means not necessarily actual physical cash, it can be even the bank transactions. So when the money is coming in and when the money is going out, you record the transactions. But in case of the mercantile system, you do not record necessarily only the cash transactions, but the transactions where actual exit or the incoming of the money is not taking place, still you record the transaction, and that is what precisely said in the concept of the accrual. That is what the precisely said in the concept of accrual. Now you know very well how the balance sheet is being prepared, and on the liability side, there are certain transactions or there are certain account heads which we do record. For example, outstanding expenses. What is exactly means outstanding expenses? Outstanding expenses means expenses which I am supposed to pay but I have not paid, and they are known as outstanding. So it can be anything: outstanding rent, it can be outstanding salary, it can be outstanding electricity, telephone bill, printing, any expenditure. So if any expenditure which I have incurred but not paid, so when am I going to pay? I am going to pay in the next accounting period, or I am going to pay in the next period. So when I am talking about that I am going to pay in the next period, there is a cut-off date, and that we have already seen about the accounting period. Now I am closing my books of account on 31st of March. You know all very well, our financial year begins on the 1st of April and it ends on the following 31st of March. So on 31st of March, I will be closing my books of account. Normally, how the salary is paid? Let me ask one simple question. How the salary is paid? Salary is paid when an employee is working for the entire month. By end of the month or in the beginning of the next month, you pay the salary. So right now we are in the month of September. When the September month salary will be paid? September month salary will be paid in the beginning of the October. September month salary will be paid in the beginning of the October. Now when we are talking about the month of March, in the month of March, how exactly the situation will happen? In the month of March, the March month salary will remain outstanding or due or unpaid, which will be appearing on my liability side of the balance sheet as a current liability, outstanding salary. When am I going to pay that? I will be making the payment of that outstanding salary in the month of April. So that is nothing but we are recording it in the books because it is the accrual. Accrual means something which is due but not paid. Something which is due to receivable to me but I have not yet received. I'll give another example. Let's say that I have got a fixed deposit. I have got a fixed deposit with some company or with some bank, and the banks are paying me the interest on a quarterly basis. Banks are paying me the interest on a quarterly basis, or the company is paying me interest on the fixed deposit on a quarterly basis. The last quarter means January, February, March. The interest will be due to me on 31st of March. Correct? Because as I told you, we are maintaining the quarterly. So 31st of March, my interest will be due to me. But do you know something? When my passbook will show me the entry for the interest credit, it will show the entry on the month of April. So I can record that expenditure as well as the income. For example, in case of this interest on the fixed deposit. So interest on the fixed deposit, I will be recording it as interest due but not received, which will appear on the asset side of my balance sheet under the head current assets. So the accrual concept, now please remember one thing. If we are not maintaining the accounts with the mercantile system, if we are maintaining the accounts with the cash system, then the question of outstanding expenses or the expenses due but not paid, income due but not received will not be recorded. But we are maintaining the books of account as per the mercantile system, and that is the reason why we record the transactions of accruals. Accruals means it can be either considered as an expenditure also, or it can be also considered for the income. So that is about the accrual. So these are the different concepts. Now, by the time you must have understood one thing, that we are maintaining the books of account, we are drawing the journal entries, we are having the ledger accounts, we are having a petty cash book, a cash book, then we are having a rectification of entries, then the bank reconciliation statement, then the trial balance and all that. Now, after understanding these concepts, probably you will understand that why the transactions are recorded in a particular manner. Why the transactions are recorded in a particular manner. Now let us go to the other part of it, and that is the conventions. Now what are these conventions? Conventions are the accepted rules of a particular business. Let me repeat, conventions are the accepted rules of the particular business. If you look at the three different conventions, you will find that they are required in order to have a reliability of the accounts. Now let me explain you. The first convention is a consistency, the second one is a conservatism, and the third one is the materiality. Consistency in maintaining of the accounts, if it is missing, can anyone rely on my accounts? Consistency means following of the same policies and the principles for maintaining books of account. Following of the same policies and the principles for maintaining of the books of accounts. So if I am not consistent enough, nobody will rely on my accounts. They will say that your accounts are not trustworthy because they are not in a consistent way, or they are not maintained in a same way how they were maintained in the earlier year. Now, does that mean it's rigid that once I accept a particular method, am I going to stick it for indefinite period of time? Answer is no. Answer is no. I'll give one small example. There are different methods of the depreciation. Straight line method, reducing balance method, insurance policy method, sinking fund method, so on and so forth. There are different methods of the providing depreciation. Can I change from one method to the other method? Yes, I can. So consistency does not mean rigidity. Consistency does not mean rigidity. It also implies that there is a flexibility, but flexibility should not be at the cost of hopping from one method to the other method without maintaining the records for a fairly longer period of time. Means, just to take an example, this year I am providing the depreciation as per the straight line method. Last year I was providing with the reducing balance method. Next year probably I may not provide any depreciation. In the fourth year I will provide with some insurance policy method. So my accounts will not be reliable. Why? Because there is a lack of consistency. There is a lack of consistency. Now this same thing you can apply in case of some other way. Now I gave you the example of the maintaining of the books of account, especially of the assets, on the basis of the providing of the depreciation on different method. Let us talk about the inventory. Now what exactly inventory means? The stock. Now stock comprises of different things. Your raw material is there, your semi-finished goods are there, your finished goods are there, and one more, that is the packing materials. So your inventory consists of not only the finished stock, but it consists of all these four different type of part and parcel of the inventory. Now there are different methods of the valuation of the inventory. What are the different methods of the valuation of the inventory? Last in, first out, first in, first out, simple average method, weighted average method, highest in, first out, next in, first out, cost price, market price, n number of methods are there. There are not less than 7 to 8 different methods. But if I am not having the consistency in the method for the valuation of the inventory, my inventory valuation will show a total different result. Because the closing stock, once if it is valued at the first in, first out, that is FIFO method, and in the second year immediately I switched over and go to the LIFO method, my valuation will differ, my profitability will differ, and it will show some wrong picture. So the person who is studying this, because normally what happens, we are under impression that only the owners are concerned about the accounts. We only feel that only the owners are required for the accounts, or only they are concerned about the accounts. But the reality is, owners no doubt, they are responsible for verification of the accounts or whatever the statements which are being given, they own that responsibility. But at the same time, the same accounts are studied or verified by the different entities. For example, your employees are concerned. Now, how the employees are concerned with the performance of the company? Yes, because unless and until my own employees will know that what is the profitability of the company, what are the amount of the expenses incurred for the labor welfare or for the employee welfare, whether there is any bonus given by the management to. So as an employee, I am concerned about this. Suppliers. Now suppliers are the people who are supplying me the goods and the services. There can be the supplier for the assets as well, unless and until they find out what is the position of my repaying capacity. Means how am I going to pay them? Am I going to pay them in time? They will not deliver me the goods. They will see that what is the trend of the company or my business, that how much the credit period do I enjoy, and depending upon that they will decide whether to supply the goods or not. So this consistency is required even for the suppliers. This consistency is required even for the supplier. So suppliers will verify, employees will verify, shareholders will verify, the bankers will verify, the borrowers will verify, your customers will verify. So all those people, they are going to study your financial accounts. So financial accounts are same. My trading account, profit and loss account, profit and loss appropriation account, balance sheet, but it will be seen by the different people from their perspective. So unless and until there is a consistency, my accounts will not remain as a compatible, or they are not remaining as a comparable. The second convention which we are going to see is the conservatism. Not exactly we means conservatism. Let me tell you, sometimes it is confused with the word pessimistic approach, but it is wrong. Conservatism means you are not going to consider the profitability into account unless and until you receive that. Unless and until you receive that. But you are going to consider the losses if there is a possibility of suffering them. Now, I'll give one small example. Let's say that I have got unsold goods. I have got the unsold goods and I have valued them at the cost price, and my cost price per unit is rupees 10. My cost price per unit is rupees 10 and I am having unsold goods of 1000 units. So my total cost of the inventory will be 1000 into 10, that is 10,000. 1000 into 10, that is my 10,000 will be the unsold value of my goods. Now imagine a situation that my product is very well accepted in the market and there are no competitors for my product. There are no competitors for my product, and there is a strong information which is made available to me that my product is so liked by the customers in the market that it can be sold in the market at a very high price. What is a very high price? Say, imagine that it can be sold at 16 rupees per unit. My cost price is 10 rupees. I am expecting that it can be sold at 16 rupees per unit, but expectations and the realizations are two different things. So I cannot show my valuation of the stock at the 16 rupees because I have not received 16 rupees. I hope you have understood. Valuation of the stock at 10 rupees because I am valuing it at my cost price. But that 16 rupees which I may receive tomorrow, which I am not going to account for unless and until that money is actually received by me in the books of account. So if I sell my goods at 16 rupees per unit, then I will record the difference between 16 rupees and 10 rupees, that is 6 rupees per unit as my profit. But if I am unable to, then I should not overstate my profits. So the conservatism principle says that never anticipate profits or the gain unless and until you receive them. But if there is a possibility that you are likely to suffer some loss or you are likely to incur some expenditure, do make a provision. Do make a provision. Now, what do you mean by the do make a provision? Let us say that there is some legal matter going against the business of the owner or against the owner related to some. You have promised some customer that you will be giving a delivery of the goods, but you are unable to give the delivery of the goods, due to which there is a breach of contract, and he said that I am going to sue you, and there is a pending matter in the court of law, and there is every possibility that you may win or you may lose. But suppose if any chance, if I lose the case, whatever the damages which may I have to pay in future to that customer of mine will be provided in the books of account, because that goes along with the conservatism. Here a question may come in your mind. In the earlier case, if my goods are going to be sold at 16 rupees, I have not recorded the profit of 6 rupees per unit. Why? Because I have not received those selling price. Then why am I recording the losses which might happen because of the compensation which I may have to pay? Suppose if I have to pay the compensation, in that case I have to record that for the simple reason to anticipate the losses. So here I am expecting that there will be some losses which I incurred by me, and that is the reason why I will be recording it, and that is known as the conservatism. Now the third convention which is there, that is materiality. Now what exactly you mean by the term materiality? Materiality means significant. Now what is significant for a small scale business may not be significant for the medium size, and whatever is significant for the medium size business may not be significant for the large size company. Now let us take one small example. Advertisement expenditure of rupees 5,000. Imagine the same transaction, how it will be useful or how it will be a material for a business having a turnover of rupees 1 lakh, having a business turnover of rupees 100 lakhs. Imagine 5,000 advertisement expenses recorded separately by a business having a turnover of rupee 1 lakh and having a turnover of rupees 100 lakhs. The materiality changes according to your profitability, according to your turnover. And if your turnover is high, your profitability will be high, and then the concept of materiality will differ. Now whatever are the insignificant value transactions are there, am I not going to record it? Answer is no. We are going to record them, but we are going to group them. See, if you recollect, in the profit and loss account, there is one title of the expenditure that is known as the general expenses or miscellaneous expenses. What is general expenses and the miscellaneous expenses? General expenses and the miscellaneous expenses is nothing but the group of those expenses which I cannot record separately in my profit and loss account. Cannot record separately means there is no hindrance for me to record. But if I start recording all those transactions, my profit and loss account will be unwieldy. So I am grouping them. So I group them together. So the significant transactions which I will be recording. Now what is the meaning of the term materiality? Materiality means the one which are significant. Significant means which is going to have an impact on my profitability. Now which transactions will have an impact on the profitability? The transactions which has got the impact on the balance sheet, the transactions which has got an impact on the profits of the business, they will be considered as a material. Now there are different type of expenses. Number one, revenue expenditure. Number two, capital expenditure. And number three, deferred revenue expenditure. Now the capital expenditure is the such which is recorded irrespective of the value. Now let me take the same example. This 5,000 advertisement expenditure. Instead of that, let's say that there is a 25,000 rupees asset purchased by the business. 1 lakh of rupees turnover company, or say 10 lakhs of rupees turnover company and 100 lakhs of rupees turnover company. Both the companies will record that transaction separately because it is material from the viewpoint of the objective. Here 25,000 rupees expenditure which I am incurring for the acquisition of the asset, and that is very important and that is significant or that is material. So that is about the materiality. So in nutshell, if you see the concepts and conventions, you will find one very important thing, that these concepts and conventions are really necessary, and without having these conventions understood by you, it will not be possible for you to maintain the books of account. Now let us go for the last part of ours, that is the accounting principles. Now what exactly you mean to say the accounting principles? These are the standard practices which are followed by any business. So I can consider it as standard practices which are followed. Now these standard practices, does that mean they are followed uniformly? Answer is yes. But these practices, even though the word standard I have used, they can change according to the changes which are taking place in the different areas of the business. Now what do you mean by the term different areas of the business? You know very well, there are different acts. There is the Income Tax Act, there is a Customs Act, there is a Sales Tax Act, there is a VAT, then LBT, different acts are there. And according to the requirement of those acts, whatever the principles are there, they are known as accounting principles, and they are rechristened or they are renamed as accounting standards. They are renamed or they are re-christened, you can call it as a accounting standard. So we know no longer we are going to say that this is accounting principle, we consider it as an accounting standard. We consider it as a accounting standards. There are so many accounting standards are there which we will be studying in due course of time. Let us understand first why these principles are made and why, what are the requirements, why, because as I told you, there are so many changes which are taking place. There are so many changes which are taking place. Earlier we used to maintain or we used to draw the balance sheet of a company in the T form. T form means this form, where this is my liability side and this is my asset side. So this is known as a T form. This was the format in which we used to prepare the balance sheet earlier, but now the format has changed and now we are maintaining the balance sheet in a vertical form, and that is the acceptable change which has taken place because of the accounting standards. Because of the accounting standards, these are the acceptable changes which are taken place. Now as I told you, now this is the new era in the sense from switching over from one formation. Actually the numbers are remaining the same, your profitability remains the same, only the presentation differs. Only the presentation differs, and that is precisely what we are to understand in case of the accounting standards, that there are liabilities, there are assets, and it is prepared in this way. Now who decides when to make the change and how to make the change? In India there are competent authorities. Number one, Institute of Chartered Accountants of India, that is ICAI, is one of the main institution which suggests the government of India that yes, these are the changes which are necessary. So you introduce a standard which can take into consideration what are the changes which you are expecting. So Institute of Chartered Accountants of India is the one. The another is SEBI, Security Exchange Board of India. Now Security Exchange Board of India is the organization which is trying to protect the interest of the small investors, big investors, similarly the brokers, the underwriters, the company, the management, the employees, everyone. So they are requesting the government of India to introduce certain standards. And the third one is Company Law Board. Company Law Board. Now what is this Company Law Board? Recently you must have realized that there are certain changes which are introduced in the company law or the Companies Act. Now the Company Law Board is the department under the company ministry who is taking, commerce ministry rather, who is taking into consideration whatever are the changes which are required. Now in order to understand this accounting standard, let me tell you only one example I want to give you. There are recently some changes made in the Schedule 6 requirement of the Company Act, and the balance sheet presentation which was done earlier and which is done right now, they are the different. Now in case of accounting principles, you must have heard about one more terminology, and that is known as GAAP, Generally Accepted Accounting Principles. Now these are the, why it is known as the Generally Accepted Accounting Principles? Because our business houses are no longer doing business only in India, but they are also doing businesses outside India. A company which is listed on the Bombay Stock Exchange or the National Stock Exchange, if they wants to go and do certain business in out of India, then they can get their shares listed in the form of ADR, American Depository Receipt, and Global Depository Receipt. So in ADR or in GDR form, this can be listed on the stock market. So for that matter, the accounting principles are necessary. For that matter, the accounting principles are necessary. So let me just take the brief review or sum up what we have discussed today. We have discussed about the different accounting concepts which are divided into 7 or 8 different categories which are necessary for any business. Then the conventions which are consistency, then conservatism and the materiality, and the last part, that is accounting principles. And basically the accounting principle, I just gave you the only introduction that what exactly the accounting principle means. Are they rigid? No, they are not rigid. They can be introduced as and when they are required. Whenever the situation arises, there is a new accounting standard which is introduced. And these accounting standards which are introduced or added, some accounting standards are added, like depreciation accounting standard is there, valuation of the stock standard is there, how to do the investment accounting, foreign exchange transaction. There are so many accounting standards are there. They are introduced, and the associated agencies which are instrumental for these standards are Institute of Chartered Accountants of India, SEBI, Company Law Board. And why these accounting principles or to be specific accounting standards are there? Because of the generally accepted accounting principles. So this is what exactly we have covered today. Okay, by the way, anybody has got such type of a doubt by any chance that is it necessary all those concepts and conventions even for a small business of a sole trader? Because normally we have got that feeling that I am a small person, I am a sole trader, so why am I supposed to know all those things? Means I might be knowing, but is it necessary for me to implement that? Anybody has got that doubt? And the answer is yes. Whether yours is a small business, medium sized business, large business, company, organ, anything of that sort, but this is all required. Imagine any transaction of any sole trader. Can it be possible without maintaining of these or understanding of these concepts? Suppose imagine that there is no accounting period. Am I in a position to know what is my profit or loss? No. Historical cost. If I start recording the transaction according to the market value, sometime at the cost value, whether it will be of any use to me? Of course not. Business entity. If I consider my business and myself as one and the same, if I consider my business and myself as one and the same, then will it be anything useful for me? Of course not. So all these concepts, they are equally important. Now look at this. The conventions which are given, consistency. If there is no consistency in maintaining my books of account, my books of account has got a zero value. My books of account has got a zero value because nobody will rely my books of account. They will say your business has got no consistency in recording. Conservatism. If I am anticipating that I will be making huge amount of the profit, and if I start recording that in the books of account, I will be showing the wrong picture, and which is totally not related to the business ethics. So I cannot overvalue certain things and record it. So conservatism has to be there. And materiality, as you know very well, the significant transactions. Now the concept of significant differs from person to person. For a small business, even a small expenditure will be a significant one or a material one. Whereas for a multi-crore business or what you can say, having a huge turnover, for them it will be different. So it all depends upon what type of activity your business is in. So that is about the materiality. And as I told you, accounting standards, they are mandatory. Certain standards are very important and they are related with your syllabus and the day-to-day business or the books of accounts which you do maintain. So for that matter also, it is very important. So these are the accounting standards. Okay. Thank you very much.